The Irish commercial property market has remained active in recent months, with encouraging volumes of transactional activity continuing to be recorded in all of the main occupier markets, buoyed by a positive economic backdrop. Prime rents have continued to increase in all sectors and are firmly on target to reach our year-end forecasts. We've seen continued activity in the development land and the hotel and licence sectors of the market in recent months, and we do expect this to continue into the summer, with a number of high-profile sales due to conclude. We've also seen continued activity in the investment sector of the market over recent months. With employment growth in the Irish market having increased for 13 consecutive quarters now, activity in the Dublin office market remains strong. In total, over 52,000 square metres of office take-up was recorded in the capital in 50 individual lettings in the first 3 months of the year, and activity during April has remained robust. Almost two-thirds of the lettings signed in Q1 were to Irish companies, which is particularly encouraging, with 7 of the 10 largest lettings signed in the quarter comprising expansions of existing businesses. Occupiers that are currently looking for accommodation in the capital include Jazz Pharmaceuticals, Glassdoor, Fleetmatics, Ardagh Glass and Intercom. With available stock in Dublin 2-4 remaining scarce and rental values continuing to rise as a result, there has been a spillover of activity into adjacent postcodes and indeed suburban locations over recent months. With visibility on new office stock now becoming increasingly evident, the urgency to secure accommodation and conclude negotiations has eased somewhat. Many occupiers are now demanding more flexible lease terms, such as short leases. Indeed, many technology companies are focusing primarily on subletting opportunities on the basis that this allows them greater flexibility, such as securing lease terms of less than 10 years duration, which is important to them considering the pace that these companies typically expand at. In other cases, occupiers are committing to short-term leases for now, on the basis that there will be greater availability in the medium term. Planning was recently granted for what will ultimately be the tallest building in Dublin, the EXO in Dublin 1, which will extend to over 20,000 square metres. A number of other planning applications have been lodged in recent weeks, and we're now seeing an increasing number of schemes being proposed in suburban locations. Within Dublin city centre, there are now 27 schemes under construction, although less than 100,000 square metres of new stock is actually due for completion this year. Prime rents have continued to increase again in recent weeks and are currently approximately €619 per square metre or €57.50 per square foot, and are firmly on target to reach our year-end targets. Vacancy rates in Dublin are currently in the order of 7.7%. Take-up of almost 65,000 square metres was achieved in the Dublin industrial market in the first quarter of 2016. That was a strong result, albeit down compared to the bumper activity recorded in this sector in 2015. This demonstrates the extent to which the scarcity of modern industrial accommodation in some core locations is impacting on transactional activity in this sector at present. Although prime industrial rents have increased to approximately €80 per square metre or €7.45 per square foot, in recent months they've not yet recovered to a level that renders new development viable. As this situation changes, we expect to see some speculative development activity emerging in this sector later this year. Indeed, Rowan Holdings recently announced an intention to lodge planning to develop new industrial facilities at North City Business Park, Dublin Airport Logistics Park and at Cheeverstown near City West. Meanwhile, Green REIT is currently developing a 4,100 square metre logistics facility at Horizon Logistics Park near Dublin Airport on a speculative basis. The former Electrolux facility on the Nace Road, on a prime site of over 4 acres, has recently been launched for sale to the market, guiding over €4 million, and this is expected to generate strong interest. We expect to see continued upward pressure on industrial rental values over the course of the coming months, as the pressure to secure modern accommodation intensifies further. The upward pressure will be most acute for prime accommodation, although secondary rents are expected to rise further also. Prime industrial yields are steady currently at 5.75%. There's no doubt but that the economic backdrop in Ireland is very supportive of the retail sector of the economy at present, with consumers' confidence higher than it has been for more than a decade, and strong retail sales activity being recorded across a range of different sectors of retail. The biggest frustration in the Irish retail property market currently is a severe scarcity of stock in the shopping centres, high streets and retail parks that retailers are specifically targeting. The length of time negotiations are taking is also frustrating, with landlords in general being much more selective about the tenants and indeed the lease terms that they're willing to accept, now that the market is showing signs of recovery and the next phase of rent reviews are approaching. The retail recovery that first began to materialise in the Dublin market last year is now becoming increasingly evident in secondary and provincial locations, and we expect this to continue to exert upward pressure on rental values in prime schemes and streets throughout the country over the course of the coming months. Although there's an encouraging volume of activity happening around the country, much of the demand for locations outside of Dublin is still emanating from a relatively small pool of retailers. For the first time in a long time, we're beginning to see evidence of premiums and key money emerging in the restaurant sector where competition is particularly intense. We are confident that demand will continue to strengthen in the retail sector over the course of the coming months. However, with premises proving so difficult to source in the current climate, the likelihood is that several potential new entrants will struggle to secure premises in the particular schemes and streets that they're specifically targeting. Total returns in the Irish commercial property market in the year to the end of March 2016 were 23.5%, according to MSCI, with 2.9% growth achieved in the first quarter. This clearly demonstrates that while the Irish investment market continues to significantly outperform other markets, the pace of growth has slowed compared to the exceptional growth experienced in 2014 and 2015. The sale of Blanchardstown Town Centre will provide a boost to Irish investment spend in 2016, following the completion of more than 735 million of transactions in the first 3 months of the year. However, with deleveraging activity now winding down, most of the stock coming to the market at present is in relatively small lot sizes, which will impact on transaction volumes as the year progresses. There's been strong appetite for the various loan portfolios that have recently been offered for sale, Projects Emerald, Ruby, Abbey, and we anticipate similar demand for the Project Talca portfolio, which is expected to be launched for sale shortly. However, once these large portfolios have traded, much of the deleveraging activity that has characterised the Irish market for several years now will have been completed. Monetary policy continues to influence asset pricing in Europe. And against this particular backdrop, Irish real estate, which offers the potential for significant rental growth, does remain attractive to investors, particularly institutional investors. Prime yields in the Irish market remain stable. However, with investors increasingly focused on core assets that offer more defensive characteristics, an increase in secondary yields cannot be ruled out as the year progresses. In the development land sector, there were 28 development deals totalling more than 350 million sold in the first quarter of the year. We have continued to see healthy volumes of activity in the development land sector in recent months, with several transactions being completed both on and off market. There's a considerable weight of capital chasing development opportunities at present, with institutional buyers and listed vehicles particularly active. However, many of the sales that are being offered for sale at the moment are not of significant scale, which is frustrating to buyers, particularly considering the not insignificant supply-demand imbalance that exists in sectors of the economy such as housing. We expect to see a slight increase in the volume of development land being offered for sale over the coming months. Interestingly, we are seeing increased appetite for apartment sites in Dublin lately, despite the fact that apartment development is not yet evident in the capital. We're also seeing huge focus on sites for alternative uses, such as student housing. While there's undoubtedly appetite for additional purpose-built student housing, we would urge developers to proceed with caution, considering the vast number of student housing schemes that are now entering the planning process, on the basis that this sector is quite specialised and to a large degree untested in a Dublin context. 14 hotels totalling more than 47 million sold in the Irish market in Q1 2016, and this activity has continued in recent weeks, with several hotel property sales being negotiated. The sale that has dominated the headlines has undoubtedly been the 4-star Gresham Hotel on Dublin's O'Connell Street, which has attracted a huge amount of interest. Second-round bids are due on this asset later this month. In addition to various asset sales concluded recently, a significant number of other hotels are due to change hands as part of various loan books that are currently being traded in the Irish market. Hotels that are currently on the market for sale include the well-known Lyrath Hotel and Spa in Kilkenny, which is guiding in excess of 20 million, Ballycastine Hotel and Resort in Tipperary, which is guiding in excess of 2 million, and the Bram Stoker Hotel in Clontarf, Dublin 3, which is guiding €950,000. As we approach what is expected to be a busy season, there is a depth of demand for all types of hotels around the country, from a range of different buyers who are encouraged by very strong tourist numbers and improving hotel performance statistics. A number of budget brands, including Premier Inn, Motel One, Block, Citizen M and Yotel, are all reportedly looking for opportunities in the Dublin market at present, considering the prevailing shortages of hotel rooms in the capital. However, there's only one hotel due for completion in the city in 2016. Having said that, we've continued to see a large number of planning applications for new hotels being prepared and lodged in recent months. We've continued to see activity in the Dublin pub market over recent months also. According to our research, 8 pubs, totalling over €9 million between them, sold in the capital in the first 3 months of the year. In summary, the first 4 months of the year have been very active in the Irish commercial property market, with a large volume of transactional activity being recorded, particularly in the occupier sectors of the market, which is encouraging. Prime rents in all sectors are on target to meet the forecasts we released earlier this year. A busy summer is now in prospect, although it is expected that the volume of investment stock being offered for sale will continue to decline, in line with the cessation of deleveraging activity over the coming months, making it more challenging for the many funds and institutions that are focused on sourcing prime opportunities in the Irish market.